In this week's video, we'll review the latest data and charts to help us answer the question, is the bull market long in the tooth or just getting started? To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. We know from past videos that all market profiles are basically made up of three basic components: bullish uptrends, sideways consolidation, or bearish downtrends. And the way that we analyze trends is identical on short-term time frames relative to very long-term time frames and everything in between. The same fractal principle applies to chart patterns as well. In this week's video, we'll use historical examples and then tie these concepts into the present day or late September of 2017. We know the longer a market goes sideways, this is a form of consolidation, but it's also a trading range or a chart pattern. The longer we go sideways, the bigger the move that we can expect to get. We either get a bullish breakout or bearish breakdown. We also know that harder markets, frustrating markets, are typically followed by easier markets, or trendless markets are typically followed by markets marked by longer secular trends. Moving closer to the present day, we're looking at the NASDAQ. This is 1984. This is 1991. This is a monthly chart. One of our three forms is present here. This is consolidation that lasted 6 years. The longer a market goes sideways, the bigger the move that we can expect to get. In this case, after the 6 years of sideways consolidation, we saw a bullish breakout. We can see this, measure it, and put it in a model when the odds were in our favor here. After that, good things happened for 9 years, with the NASDAQ tacking on an additional 952% from this point A here to this point B here. Once again, we're looking at a monthly chart of the NASDAQ. This is 1995 on the left side of your screen, and the present day, late September of 2017, on the right side of your screen. The longer a market goes sideways, the bigger the move that we can expect to get. In this case, the NASDAQ stayed inside of this trading range or inside of this box for an unbelievable 21 years. Bottom of the box, 1996. Top of the box, calendar year 2000. Bottom of the exact same box in 2002, 2009, and back to the top of the box again in recent years, and finally breaking out above this level here late in calendar year 2016. You can make an argument that there's some subjectivity to drawing a box like this. We would counter with a 100% objective statement. The NASDAQ made absolutely no progress from point A to point B for 17 years. This is what consolidation looks like. The NASDAQ made absolutely no progress point to point from 1996 to 2009. That's a 14-year period. Regardless of how you draw the box, this is an indisputable fact from point A to point B, and an indisputable sideways movement from this point here to this point here, and all the way out to this point here. We also know that the longer a breakout holds, the more relevant it becomes. If this breakout holds, we are very, very, very early into the process. The breakout occurred less than 1 year ago, as of September 29, 2017. And we just showed that after a similar 6-year period of consolidation, after we saw a bullish breakout at point A, the NASDAQ rallied for 9 calendar years and tacked on an additional 952%. The longer a market goes sideways, 21 years is quite a bit longer than 6 years. This point A here is very, very similar to this point A here. How do we know that? Market fractals. We treat a consolidation box that lasted 21 years the exact same way that we would treat a consolidation box that lasted 21 minutes if we were trading 1-minute charts, telling us to remain open to much, much better than expected outcomes. It is within the realm of logical possibility that the NASDAQ could rally in this direction for several more years. A counter-argument might be, but we haven't had a bear market in ages. We're overdue for a bear market. Clients and regular viewers will remember that we've already covered this topic, and we really don't agree with that statement. And more accurately, the facts don't agree with that statement. We've presented this stat before. This is USA Today, January 8th, 2016. The Standard & Poor's 1500 Index, a broad basket of large, mid, and small cap stocks, shows that the average stock's distance from its 52-week high is almost 27%. In terms of the broad market, we just had a bear market. And since it's always good to hear a similar story from a third party, if you still want to make the argument that the present-day bull market is long in the tooth, you should Google this title here and read this fantastic article dated September 22nd, 2017 from Barry Ritholtz. The title sums it all up. There's nothing old about this bull market. And similar to the stats that we've presented in previous videos months ago, from the peak in 2015 to the lows early in 2016, the median S&P 500 stock saw a drawdown of 25%. Small caps were 27%. They fell 27% from high to low. Japanese stocks, 29%. The trannies, 32%. Emerging markets were down a whopping, and I can't sleep at night, 40%. Chinese stocks lost almost 50% of their value. Small cap biotech down 51%. Crude oil dropped 76%. We should also keep in mind, this is not that long ago. We are coming off of a very, very difficult period where some investors saw wacky drawdowns, incredibly high drawdowns, possibly as high as 50%, or if you were heavily weighted to oil, 76%. The notion that things have been ultra easy is overblown. We have a very, very difficult and volatile period in our relatively recent rearview mirror. Harder markets are often followed by easier markets, and the easier markets can last for a very, very long period of time. And in the present day, the breakout from the 21-year consolidation box is less than 1 year old. Harder markets are often followed by easier markets. Trendless markets marked by confusion and consolidation are often followed by markets marked by strong secular trends that can last several years. The move in this direction does not even have 12 months under its belt as of late September 2017, telling us to keep an open mind about better than expected outcomes for several years. This is the harder market. This is a factual harder market here. This is indisputable. These are horrible, gut-wrenching drawdowns that took place between the peak in 2015 and early 2016. This is your harder market. Here's another example of consolidation and another harder market. This is the Value Line Geometric Index. It's an equally weighted index. It's a very good way to see the performance of a typical stock, much, much broader than the S&P 500, which is also a capitalization weighted index where the larger companies carry more weight. In this instance here, the average stock went absolutely nowhere for roughly a 10-year period. Harder markets are often followed by easier markets marked by strong trends. In this case, after we saw the bullish breakout, the value line geometric index tacked on an additional 75%, and the rally lasted well over 1 year. How does this concept apply to the present day? Market fractals tell us that consolidation over a shorter term period should be treated in the exact same manner that we would treat consolidation over a longer term period. This is a small fractal. This is a large fractal here. After we moved sideways for 10 years and saw a bullish breakout, the gain and the strong trend carried the market, the typical or average stock, 75% higher. Now we've been inside a similar consolidation box for 32 years. As of late September 2017, this chart is dated September 27th, 2017, we have a bullish breakout after a long sideways period of consolidation and confusion. The look of this chart here, we would treat this the exact same way that we would treat 32 minutes of consolidation if we were trading a 1-minute chart. We would treat it the same way that we would 32 weeks of consolidation if a weekly time frame is what we were focusing on. This point A here is very, very similar to this high probability point A here. After this point here, good things happen for a long period of time. And once again, you can make the argument that the box is somewhat subjective. There is absolutely, positively nothing subjective about this 27-year period here, where the value line geometric index or the average stock went absolutely nowhere from point A to point B, and there is nothing subjective or opinion-oriented about a sideways movement that lasted 19 years from point A to point B. We are now clearly above this point B here that acted as resistance in the past, and the exact same point acted as resistance again in calendar year 2007. The longer a bullish breakout holds, the more relevant it becomes. All of these statements are based on the facts that we have in hand, no predictions needed. We are clearly above these 2 points here. The longer that lasts, the more relevant it becomes. If we get a failed breakout, we will also learn something from the failed breakout as well. This breakout here that was followed by a 75% gain is very, very similar to the breakout that occurred late in calendar year 2016. This is a 32-year period of consolidation. We are less than 1 year into the breakout, telling us that just like good things happen for a long period of time after this 10-year period of consolidation, we have to be open to good things happening for a long period of time after a 32-year period of consolidation. We'll take it day by day and continue to monitor the charts with an open mind. These statements are based on what we have in front of us today. If the facts change, then our assessment of the probabilities must change as well. And as we near the end of September, we're happy to report when we had the watershed moment in mid or late May of this year and added those new screens, we added growth to our portfolio, large cap growth, and tech. We, of course, have exposure to the S&P 500. If we look back 90 trading days from September 28th, 2017, back to May 23rd, 2017, this is where we added the screens. The S&P 500, or SPY, is up over 5% in red, and tech and large cap growth are both up over 6%. This is 90 trading days, or 129 calendar days. We understand this is a very, very short evaluation period, but we're very, very pleased with the performance of the new screens and continue to believe that the new screens in this shift are a watershed moment for the market model. And always, with the benefit of hindsight, capturing gains over 6% or over 5% seems relatively easy. Markets never make anything easy on any one. These graphs show us that, as we would suspect, on an intermediate term time frame, a short term time frame, or a long term time frame, we are always going to see normal and 100% expected volatility between a point A and a point B. There's been a lot of volatility in here, and thankfully, the model was able to successfully classify this volatility as volatility to ignore within the context of an existing and ongoing uptrend. The market model is a well-diversified model, and a big component of the model, one that we don't cover in these videos that often when the markets are trending strongly, is asset class behavior. Does asset class behavior align with the bullish charts that we've covered previously in this week's video? The answer is yes. This is stocks, the S&P 500, relative to long-term treasury bonds. We're using a mutual fund proxy here. This is a lot like TLT in the ETF world, WHOSX, stocks versus bonds. You can see the ratio peaked here in late 1999 and remained in a downtrend, and we got a bullish breakout in calendar year 2013. This would be step one of a trend change. We have a well-defined downtrend. This is an attempt at flipping over to a bullish trend. Step one, break a downward sloping trend line. Step two, make a discernible higher low. This is a higher low relative to this low and this low. And then from a probability perspective, to confirm the trend change, we need to see a higher high above this high. And that's exactly what occurred late in calendar year 2016. And right now, as of late September 2017, this bullish breakout from this consolidation period is holding. The longer a market goes sideways, the bigger the move that we can expect to get. We're not making any predictions about what happens next with this chart. As always, we are looking at the facts, no opinions, the objective facts that we have in hand as of late September 2017, and we'll continue to take it day by day with that flexible, unbiased, and open mind. If you want a little bit more insight into the concept of a trend change, you can Google this title here and see some additional charts on See It Market. From a hypothetical perspective, if the market does move in this direction for a long period of time, and that is to be determined, we know that the point A to point B move will not be a straight line. Volatility is to be expected, and we have to know that volatility is not the enemy. The positions that we have today give us a very, very high probability of navigating from a point A to a point B that could occur several years down the road. We're not concerned about what ETF performs best over the next 3 days, 3 months, or even 9 months. We want to give ourselves a very, very high probability of remaining as close to fully invested as possible within the context of the math between a point A and a point B. And when we're moving from point A to point B, it is incredibly important to understand that volatility is not the enemy. Our objective is not to avoid volatility. Volatility is 100% normal and to be expected during any long-term bullish trend. It's just the way things work. The market's not going to make it easy on anyone. And if we can successfully navigate from a point A to a point B, history tells us that even if we owned just the average stock, if we can successfully navigate from point A to point B, we should be able to capture very, very satisfying returns. This is being recorded at 2:41 p.m. Eastern Time on Friday, September 29th. Over the last 5 trading sessions, the S&P 500 is tacked on over 14 points. A week ago, we knew that the trends looked strong. If we gained 14 points, the odds say they are still strong. This chart here, Friday, September 29th at 1:36 p.m., we can see that the trends and the hard evidence that we have in place still looks a lot more like these favorable periods after this good things happen for a very long period of time. This is another example. Even if you just owned SPY between point A and point B, and you were able to classify most of the volatility as volatility to ignore between point A and point B, your gains, regardless of whether you were in the best ETF, would have been extremely satisfying. If we're constantly worrying about whether we own the hottest ETF of the day, it's going to be much, much more difficult to navigate from a point A to a point B that could be several years out in the future. Present day chart looks a lot like this. It looks a lot like this, which speaks to the probability of good things happening relative to the probability of bad things happening, which is never zero. If we want to navigate from a point A to a point B, we have to know in advance that it's not going to be easy, and we have to avoid these common pitfalls. And also keep in mind there's always a scary list that can be compiled, and when we're in the present day, our money, egos, emotions, the psychology of the markets are all back in the equation, which requires discipline no matter how strong the trends have been or how strong they're going to be in the future. In this case here, if you just owned an index from point A to point B, you didn't have to own the fancy and hot ETF of the quarter to capture very, very satisfying gains between point A and point B. One of the keys is we have to understand there's going to be volatility. It's all summed up here when you have strong trends. In other words, in order to see those really large gains, you have to be willing to see those gains erode significantly before getting out of the market. The answer from our market wizard, I can't see any other way. If you get too careful about not risking your gains, you're not going to be able to extract a large profit. This is the big picture. This is the short-term focus that will get us off track. And even though the charts look good today, we will wake up tomorrow with a flexible, unbiased, and open mind, knowing that eventually, whether it's 3 minutes from now, 3 days from now, 3 months from now, or 30 years from now, our high probability and favorable charts will morph into something that's unfavorable, and we will move from volatility to ignore within the context of an ongoing and bullish trend, to volatility to respect that requires defensive action. We can see this, measure it, put it in a model before really, really bad things happened. It's one thing to put our capital in harm's way when the odds are in our favor. It's a completely different thing to have an exit strategy in place before you need to implement that exit strategy, providing us with that incredibly valuable peace of mind. We track all of this and convert it into a usable and actionable format in a reasonable amount of time. The submodels, we answer binary questions, some of them manually done, some of them programmed in Excel, and we also enter in unbiased and hard data. The submodels allow us to get a handle on the market's current profile, and the master CCM market model then looks at the current profile compares it to past profiles, and recommends a prudent allocation between risk assets such as stocks and conservative assets such as bonds. Conservative assets can consist of cash, bonds, currencies, or any number of investment options. If you'd like to learn more about the market model or our money management services, you can visit our website, follow along on Twitter, Facebook, read our blog Short Takes, or watch past videos on the Shavaco Capital channel on YouTube. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.